Dissecting journal entries using example, part 3. Our first journal entry type is goods withdrawn for personal use. On 10th March, goods worth $1,000 were withdrawn from the business. Following is the journal entry. Accounts involved in this transaction are drawings account and purchases account. Similar to withdrawing cash, when the owner takes goods from the business for personal use, it reduces their equity or capital in the business. This reduction is recorded as a debit to the drawings account. When goods are taken by the owner for personal use, they are no longer available for sale. Crediting the purchases account removes the cost of these goods from the total purchases made for resale. This ensures that the cost of these withdrawn goods is not included in the calculation of the cost of goods sold. Our next journal entry type is depreciation. On 31st March, depreciation is charged on the furniture. Following is the journal entry. The accounts involved in this transaction are depreciation account and furniture account. Depreciation represents the allocation of the cost of a tangible fixed asset over its useful life. It is treated as an expense for the accounting period during which the asset was used to generate revenue. Expenses are recorded with a debit. Instead of directly crediting the furniture asset account, depreciation is credited to a contra-asset account called Accumulated Depreciation. This account represents the total depreciation charged against the specific asset or class of assets since it was acquired. It reduces the net book value of the asset on the balance sheet. An increase in this contra-asset account is recorded as a credit. Our third journal entry type is accrued income. On 31st March, an interest income was earned but was yet to be received. Following is the journal entry. The accounts involved in this transaction are accrued interest and interest income. According to the accrual basis of accounting, income should be recognized when it is earned, regardless of when cash is received. Since the interest has been earned by 31st March but not collected, the business has a right to receive this amount. An increase in assets is recorded as a debit. The amount earned represents revenue for the business for the accounting period ending 31st March. Revenue increases equity and is recorded as a credit. Our next journal entry type is interest on capital. Here we have $2,000 interest on capital which is said to be allowed to the owner. Following is the journal entry. The accounts involved in this transaction are interest on capital account and the owner's capital account. When it says allowing interest on capital, it means the business is treating the owner's investment in the business as if it were a loan from the owner to the business. Basically, allowing interest on capital is a way for the business to recognize the financial contribution of the owner and provide them with a return on that investment. From the perspective of the business entity, allowing interest on the owner's capital is treated as an expense or an appropriation of profit. It represents a charge against the business's earnings for the use of the owner's funds. Expenses are treated as debits. The interest allowed increases the amount that the business owes to the owner. This effectively increases the owner's equity or capital balance in the business. An increase in the owner's capital account is recorded as a credit. Our final example of journal entry is provision for doubtful debts. Here we have to create a provision for doubtful debts at 5% on debtors of $50,000. Following is the journal entry. The accounts involved in the transaction are the bad debts expense account and the provision for doubtful debts account. As we know, the bad debts entry recognizes the estimated expense associated with potential uncollectible accounts receivable during the period. Recording this expense adheres to the matching principle, attempting to match the cost of the potential bad debts with the revenue from sales that generated the receivables in the same accounting period. Expenses are debited. The provision account is a contra-asset account, meaning it is linked to and reduces the reported value of accounts receivable on the balance sheet. Instead of directly reducing the debtor's account, which would remove specific, known uncollectible amounts, this provision estimates potential future write-offs from the entire pool of debtors. Crediting this account increases its balance, thereby reducing the net realizable value of debtors.